Hello, I'm Robin Gibson, and this is your Harvard House Money Morsel. Welcome back. Thank you for joining us. Please don't forget to like and subscribe. Click the bell so you get a notification whenever we release a new video. I'm sitting again with Michael Porter, Chief Investment Officer. Michael, morning. Thank you for joining us.
Morning, Robin.
So, Michael, we've seen in South Africa, we've had no significant GDP growth for some time. Obviously, with recent events, businesses under strain under COVID. Then we've had the Ukraine war, oil prices spiking, interest rates up. Surely this is a terrible environment for banks, or is there a different story actually unfolding?
Yeah, morning, Robin. Sure, that's a litany of woes that you ran through there. But funnily enough, Robin, it's not nearly as bad as it seems. Banks are reporting their results at the moment. All the banks have reported except for FirstRand, which will come out in the next week. And generally, the mood is very positive, Robin. And I think you've got to remember that banks were probably some of the hardest hit sectors. Was one of the hardest hit sectors in the pandemic, partly because of the regulatory response to the pandemic. So the Reserve Bank came out and issued a decree that banks couldn't pay dividends, because the last thing the Reserve Bank wanted was for banks to pay away the capital and then not have enough. If things really turned bad and the economy was under significant pressure, then they needed the capital. They didn't want the banks to be vulnerable, which is exactly the right regulatory response. There's no issue with that. But obviously, as shareholders, the market didn't take it too well. Also, you're expecting bad debts to rocket and all the associated stuff associated with the recession. Actually, that didn't really materialize, quite honestly. I think the housing market took off, as we know. People were spending a lot more time at home. They did some alterations. So mortgages were very strong, and they remain very strong on the mortgage market. Banks basically, yes, they made massive provisions for bad debts, so the profits did plummet, but they made provisions for bad debts. And over the last year, those expectations of bad debts actually haven't come to pass. So they've been able to actually write back some of those provisions and release some of those provisions because they were excessive, but they had to be conservative in the beginning. So now we look at Standard Bank, for example, who came out this week with results. And really, it's quite a good story, because there's a couple of things that really drive bank earnings, Robin. The first is net interest income. So remember, also in the pandemic, interest rates were slashed 3% from the peak to trough. And so the amount of interest that the banks earned just plummeted. That is now recovering. Interest rates are on the rise, so the banks make a lot more interest income. I know that they also have to pay more interest to deposits, but they get a positive margin on that. So interest income is at an all-time high for Standard Bank. Okay. Secondly, non-interest revenue, which is your fees and commissions, all the things that we love to complain about banks and get hot under the collar. That is also very strong in Standard Bank. And that's doing really nicely. And I think in Standard Bank's case in particular, it's really aided by their amazing African franchise. They've got a very, very strong presence across Africa. They've been building it for 20 or 25 years. And it fosters a lot of cross-border transactions and things with companies that are expanding across Africa. So Standard Bank is very well positioned, but that was strong. The third thing is credit impairments. That's the bad debts. That's very much in line. Standard Bank have a target that they want their credit impairments to be between 0.7% and 1%. It was firmly at 0.82%, which is firmly in line. Bad debts are not an issue at the moment, but they've got plenty of provisions for bad debts, which is the other nice thing, is that the banks have got more than enough provision. So even if things do turn a little bit sour from here, and they might turn a little bit weaker, the bank is actually more than well provisioned. So it doesn't actually come through the income statement. It soaks up some of those provisions that they've already made. And then fourthly is efficiencies. Every business needs to cut costs and be efficient. Otherwise, you don't make the profits or the margins. Banks are absolutely no different. And in all the banks, actually, the cost to income ratios are moving moving in the right direction. I think generally South African banking is quite high, but there's this big move online. There's this big move to digital. I mean, if you go and look at all the bank results, it's amazing how many digital transactions they process. I mean, just even think of yourself. When last did you really have to go into a branch? I've just sat this morning and done all my internet banking from the comfort of my desk, So, it's just that kind of thing where the banks are really investing a huge amount in technology. It's allowing them to cut branches and cut space, which is not, you hope that doesn't take away from the customer-facing nature of banks, but they can rationalize. Standard Bank's cut 90,000 square meters of space in the last year, which is a lot, and then the fifth thing is the capital. So the Reserve Bank requires banks to have a certain amount of capital. That's a regulatory issue. It's 8.5% core equity tier 1 capital, which is your core. That's the bottom of the foundation capital, regardless of preference shares or bonds or money market or anything like that. Standard Bank has an internal target that they want to be at 11%. That's, regulatory plus a little bit. That's good. It's sitting at 13.5% at the moment. So they've got all the banks have actually got excess capital that they've built up, partly because they couldn't pay out dividends and and bad debts weren't as bad as they expected. But allied to that is the fact that you need to earn a return on that capital. So actually, the more capital you have, the lower the return on that capital. You actually don't want excess capital because it kind of lowers your returns. Yeah. So yes, Standard Bank's got excess capital. That's allowing them to pay a good dividend. So Standard Bank have declared a dividend of 515 cents a share. It's up 43% on last year. And I think this is our whole point, Robin. So if you look at it at a 12-month rolling, so you take the final dividend from last year plus the interim and you kind of roll it forward every 6 months when they report. As we stand now, Standard Bank has declared record dividends for the last 12 months, the highest they've ever been. And yet, just 18 months ago, dividends were down 80%. And yet they've bounced back just so quickly, because actually the banks are much stronger than we feel. We don't have weak banks. Our banks are very well capitalized. They're well regulated, and actually they stand to benefit. So shareholders, having suffered that drought in income for a year, are really going to be rewarded going forward. And then just maybe one last comment on sort of the outlook. You're quite right in the whole litany of woes that you started off on, and the outlook isn't great, and GDP growth isn't fantastic down here. But some of the reforms that we're seeing, we think really start to play into the banks. All this electricity reform, all the money that's going to be spent on electricity infrastructure in this country has to be financed by somewhere. If shopping centre owners or landlords are putting solar on buildings, it all has to be financed from somewhere, and the banks are there to finance all this investment. And, already Standard Bank and Nedbank and Absa, I mean, all of them have come out, we're financing this, we're financing that, really big deals that are over sort of 20 years that really boost the loan book, obviously boost their interest income for years to come. So despite what is perceived to be a very weak economy, we don't think the outlook is nearly as bearish as people make out. And banks are very good value. They're much cheaper than they were even before the pandemic still.
Awesome. Well, Michael, you've given us a great window into the banking sector and maybe into some confidence that we can face as investors in our dividend flow and in South Africa as a whole. Thank you for joining us. Please don't forget to like and subscribe, and we'll see you again next time. Thank you.